All right, good morning. Game 41, where we will have indeed another macro tourist day. That's where everybody on Old Wall TV and with a Twitter handle will have a view on the PC report without having a model or any experience embedded therein. It's going to be a fascinating day of behavioral exercises, but we know what to do with that. China went big time bullish trend now. We get a breakout in commodities and everything from gallium, for those of you that know what that is, of course. We're long copper, we're long FXI, China. Howard's turning a little bit on Yum China. We got some stuff going on here, Alan.
Yeah, we do. I'm playing tourist down here in Florida. You know, Keith, I recently made First Watch a best idea long, which I think is a signal strength name. But anyway, going to be going to brunch at First Watch here shortly. So
yeah,
what are they?
It is the first. FWRG is on the signal strength list, and now everyone on the call can see that signal strength list because we made it a product people can subscribe to as a Monday.
This is the difficult part of my job when I have to do due diligence eating out. So three comments for me on three different companies reported earnings. First, Red Robin, 10 million in EBITDA versus estimates of 13 million. Comps were down 2.7. FactSet had them down 1.5, and then guided to lower than where the street is. The stock's down a little bit here today. I think there's very little future with this company. It's a best idea short for us, and it's not going bankrupt, but it could easily go down 30 or 40% from here. Two cannabis companies reported last night. Green Thumb beat the numbers handily and actually executed on a fairly decent conference call in what their future is going to look like. But revenues of 278 versus FactSet of 270, EBITDA 91 versus essentially $80 million. And the company announced added to their share repurchase program, which it's a nice thing that they're doing this, and it's a signal, I guess, that the company's healthy, but they need capital, right? If they're going to grow in the future, and M&A and if they're going to grow into more states and they're going to buy other companies, they shouldn't be buying back stock. Like, it just doesn't make any sense for me. But it's fine that they're doing it. And then Trulieve lastly reported also a great quarter, 87 million in EBITDA versus the 71 million consensus, and 287 in revenues versus 286. They have not had their call yet. That's just me. So both the two names on our best idea long list, Green Thumb and Trulieve, reported decent quarters. Now, they're low single-digit revenue growth quarters, so this is not an exciting huge growth story, but fundamentally, if we can get the change from Schedule 1 to Schedule 3, or rescheduling from Schedule 1 to Schedule 3, you're going to see a significant improvement in cash flow, and then you can get maybe a little bit more CapEx investment to accelerate revenue growth. But we like both Green Thumb and Trulieve, and they reported very good quarters here recently, and that's it.
Good. And we got the buy signal on the Glass House yesterday, which I'm sure you saw.
Yeah.
GLASF. You'll see that there's 60 names. That's the highest or the longest list of signal strength longs that I've had since 2021 when we were raging bulls. And can't say I was mooning like I am this morning. Just mooning. No laser eyes. I don't do laser eyes.
We will be having the Glasshouse management team on in early April after they report their quarter. We haven't confirmed the date yet, but you'll be hearing from the Glasshouse management team in early April.
That's cool. The format that McGough not introduced, but it's just like amplified for tomorrow with Beyond. I think that's a good one. That, like, if you can do stuff like that, obviously there's an exclusivity to that. And
well, interesting that you mentioned that. Cohotus is long Glasshouse brands as well.
Ooh, there you go.
Just an FYI.
I tell you, the things you hear on the call. All right, and welcome again for the fourth day on Free Access Day to those of you that are new to this. And obviously, it's an entirely different experience than watching a comedy for the first 3 hours of the morning on CNBC. Biolsi, good morning. I don't know if Bielsi's on the one day that the Celsius goes moon. I'm just going to start talking like these yo-yos, if that's okay with you, Jenks. They're mostly your age.
He was on earlier. I don't know what happened to him. I saw him on earlier. He must have. There he is. He's back.
It's just like BLC. You don't have many exciting stocks. I mean, for the love of God, I had to squeeze 3% for the home team out of Clorox, but Celsius is exciting. And you're on mute, so I think we're just going to pass on BLC today if he's not figuring it out. I don't know what he's doing.
Can you hear me now? I'm sorry. Very sorry.
What are you doing? Like, have a Celsius, dude. Wake up. Come on.
It's not me. It's all technical. I'm sorry. So Celsius, a lot of earnings. I'll try to be really quick. Sorry about that. Celsius beat by a penny. Stock's down 2%. I mean, there's just a high expectations thing for this, but the results itself were very good, and the call is all that really matters in terms of like, can they screw something up or say something that has to lower numbers? But the numbers are just amazing. Revenue up 95%. That's way above the scanner data, right? So that means the off-track channel is better than the track channel, which means it's positive surprise, and it was 97% growth in North America, 68 international. Amazon, great. Maybe the one sort of standout item to mention is like they were the #1 share gainer in the U.S. retail channel this year in 2023. So that gives you an idea of how big of a phenomenon it was. It was across the store, it was the #1 share gainer. So I'm a buyer. It's just a whole expectations thing. You sell into the news, right, for something like this. Moving on in energy, just one spot lower on the position monitor is Monster. Nothing really add there. What we have here is they're committed to raising price. This was a company that wouldn't flex their pricing muscle during the inflationary surge, and they're sort of late to the game because they never had to raise prices before, and they did, and they're committed to doing it. They're passing on prices further internationally, even more aggressively. Red Bull has already raised prices, so that gives you that visibility. That's fine. The share gains, yes, they're losing share to Celsius, but both can win at the same time because it's just a big margin catch up for Monster right now. Those shares are up free market, and then I have others, but maybe the one I'll call out lastly is Synopta, STKL. So they reported a 3-cent beat of 5 cents. Revenue grew 13.7% for them with volume mix of 14.7 and price down. So how many companies in my universe, I don't know, just less than one hand have volume growth and volume growth in double digits. So management estimated that plant-based milk market, including both the track and untracked channel, grew by mid-single digits in the quarter. So Synopta growing 3 times faster than the market, which itself is up, which people don't have that visibility because all they get is this track channel. But for Synopta, that's 80% of their business is untracked. So that's the one thing that's holding the stock back is that you see the scanner data where plant-based milk is a little bit weaker, but 80% of their sales are essentially like Starbucks and the rest of the independent coffee chain, and they're doing fine. And they're going mid-single digit, even more than mid-single digit. So everything else was on track, and they have the new CEO, and I still think shares can double from here. So that's maybe the one I'd say is actionable. But of course, Celsius, Monster are ones I want to buy because they're on the top of my list. Sorry about the technical difficulties.
That's okay. It's going to be okay. All right. Jenkins.
Hey, good morning, Keith. Sorry, I was laughing about the Celsius comment. Wanted to talk about sports betting today, and as it relates to DraftKings, which continues to be a best idea along. I figured I haven't talked about it enough this week, so got some more data on the sports betting side to start the year. Obviously January is already in the books, and we're focused on February. However, there's certain states that provide pretty good insight as to what's going on market dynamics wise across the industry, and I want to focus on. Because this is often a topic, because when you have a good revenue month, people say, well, the sports books held above average and it wasn't consumer friendly. So then that's going to create a slowdown in what people actually bet the following month. So we saw that we saw the inverse of that, or at least we were calling for the inverse of that in November, when the operators had a really tough month last November, where they held really low, and then it actually drove accelerating handle growth in December. Well, the narrative was, well, January is going to pull back because December, the books actually, hold percentage normalized. However, that's actually not what we saw. We saw a continuation of that trend. And really, if we look back over the last couple quarters, you had the second quarter in terms of handle growth, which is what people are actually betting. So true volume, not necessarily the price component of how these guys get paid. That accelerated to plus 15%. Then you went to plus 25, and then you had plus 26, and then now here in January, you're continuing on with a similar clip, actually just north of 26% growth. And really, what's interesting is if I look at the next couple months here, and really next couple quarters, you still really have easy comps until you kind of get into that October period, and we start to lap ESPN bets launch. And what's interesting now is you have promos coming down, the hold percentage normalizing, creating a very, very good environment for the operators, in particular DraftKings and FanDuel, which are top of the market, to drive accelerating net revenue growth, which was not in people's expectations even just a few weeks ago before the company spoke. I think it's more in people's expectations now that that Q1's going to be good. I think Q1's actually tracking to be a lot better than what they even guided to. So they gave themselves, again, a nice little bit of cushion, barring any major, crazy outcomes during March Madness, which can happen at times. I think the quarter is going to be a really solid one, and they'll be, have an opportunity to raise guidance. So that's that on the data side. And then legislatively, there looks to be some traction in the South. So it looks like Georgia is, it's not a done deal, but looks like it's moving towards them having a sports betting referendum on the ballot here this upcoming November. And so I think it's interesting because Georgia's gone from, the expectation was more of it's a 2026 and beyond type legalization story. Whereas now, it's probably a little bit better than 50% chance that we get it on the ballot. If you get it on the ballot, for the most part, because there's no major tribal component to gaming in the state of Georgia like there was in California, or if you recall a couple of years ago when they tried to push sports betting through, think we'll have a pretty good chance if it makes it there. And really what that does is it just pulls forward another big state, another big market, temporary EBITDA headwind, but massive revenue growth driver for all these guys. And then you get the EBITDA on the backside. Obviously, you'd love all these states to legalize sooner rather than later. If you just think about kind of, discounted cash flow of all these future states in the future, EBITDA and cash that they're going to generate for the operators. But, the data trends are solid. And I think you got some good movement on the legalization front as well, which all good things. So DraftKings continues to be our best idea long, upside into the mid 50s, I think over really the next 6 months is sort of where I peg it. And that's it. That's probably the most actionable, not probably, definitely is the most actionable from us today.
And from a signal perspective, it's still win. DraftKings was popping yesterday. We get win from the low end of the risk range. When it hits real-time alerts, it means it's very close to the low end of the range, because that's where I have to seek perfection. Believe me, if you've seen how many people over the course of the product's lifespan that have signed up for real-time alerts and don't understand it. Well, they understand it if you bat 100%, but so that's the point. Anyway, I'm just trying to communicate. Buy the damn
all you can do.
Buy the damn dips in the 60 signal strength stocks on your list, which include LVS, Wynn, DraftKings. Those would be top 3 signal strengths right now. Notice the 2 China factor exposures, and we're long of China FXI and Portfolio Solutions. I slipped that past the goalie yesterday. Oh yes, I did on red. All right, McGough, you got any China factor exposure for me?
Not this morning, but I can conjure some up for you.
Because China's just like whether you know it or not. I mean, you figured it out over the last 2 years, but you talk about bag holding. I mean, bag holding has been China. China's been awful. Felix has some new names here this morning, or at least one. But that's okay if you don't have China.
No, well, I got the biggest one in China is probably Nike, and I'm long that, but I'll tell you, I'm wavering on it for a couple of reasons. But look, I got a ton of earnings this morning, and me and Jeremy are going to tag team them. We're not going to hit on all of them. We can't. We don't have enough real estate here. But one I want to hit on, I want to start off on a small cap name, which does not have China exposure, is Figs, F-I-G-S. This is the company, if you don't know Figs, it has been dubbed the Lululemon for medical apparel. And I give this company credit. It's innovated a category that hasn't been innovated in like 100 years, but it's attracting a ton of competition. And this company came out, to its credit, it beat the quarter by 3 pennies. but guided down 2024 by a shit ton. And I'm not going to quantify it. I'll just say a shit ton. You can use your imagination. And they fired their CFO. So backtrack about 2 to 3 months ago, I recall having a conversation with this company. I don't talk with a lot of management teams. It's not a part of my process. I do my own research. But this one, they really wanted to talk with me. So I entertained the conversation and I told them, I said, look, your stock's worth $3 and your expectations are too high next year. The crap that they gave me on that Zoom call was like, I wish I could have recorded it. And now lo and behold, they come out 3 months later, they lower expectations by a lot to, squarely down top line and operating profit for 2024. And they fire the person who's in charge of forecast accuracy, which is their CFO. So this stock is trading down about 20% right now. This is the best idea short. I said it was worth $3. I still think it's worth $3. It's trading at $5 right now. So I would still be short it. I would own this at a price. I go both ways. But that price wouldn't be until it's a bone, like a $2, maybe $3 stock. If the rate of change is accelerating, which I'm not anticipating as we're headed into quad 2 later this year. So that is FIGS. Enough on that one, small cap name. The other one I want to mention before I hand it over to McLean is Birkenstock, BIRK. This is a name. It's a best idea short. It's at the bottom of our best idea short list. The company hit the quarter. It should have blown away the quarter. I mean, you couldn't keep Birkenstocks in stock if you're a retailer this past holiday, and that's the quarter the company just reported. It didn't change guidance, but it said we're now even more confident that we're going to hit our guidance for 2024. Like, explain that one. Like, so you weren't confident when you issued that guidance a couple of months ago? Now you're more confident? Like, I just don't understand. Maybe it's like a language barrier thing. This is a German company, but it is what it is. I am waiting to make this to bring this higher on our best idea short list. I think the playbook is going to be that because the wholesalers sold out of their Birkenstocks in the holiday season, like these guys buy in hindsight. They buy what already worked, not what's going to work. So the spring orders probably look pretty good, which is why they're quote unquote more confident in their 2024 numbers. So I think pod 1 is going to slow in the back half of this year. Interestingly enough, that would be pod 1 slowing for a retailer consumer company when we're in quad 1, quad 2, which would be a very bad look. So I suspect the stock will not handle that well, but I do think we have to de-risk a couple of quarters here. So I'm going to be patient on the BIRK, best idea short, likely get heavier on it later this year. And with that, let me hand it over to McLean. He's going to speed date through a couple of earnings like Best Buy, Acushnet, a couple of other juicy ones. Jeremy, you're on mute.
See if Keith had anything else you want to say there, but I can go. So I wanted to flag one thing on IPAR yesterday, just with Brian talking about guidance. I thought was very funny that the company, right, put out their guidance and the stock was trading down, and then they came out like during the call or something and said guidance will probably go higher, like because they guided a number, the stock was down, and now they're saying, oh, but we'll probably take up guidance during the year. It's like, well, you had your chance to guide. You pick your guidance, right? Anyway, the few things I want to hit on are F&D, Best Buy, and Acushnet. First one, F&D, just the company had a bunch of insider sales hit the tape, right? If your business has crashed and the market just wants to put 60 times earnings on your stock, and you probably sell some after reporting and guiding down the numbers. So F&D seeing several insider sales, including the CFO. It's a younger guy around my age, sold something like $300,000 worth of stock. So good for him. Next one, Best Buy reported this morning. This is Best Idea Short. The headline was an EPS beat, revenue a little bit ahead. You know, Best Buy does do a good job of managing the upcoming quarter expectations, so not surprising to see that headline, but slight rate of change improvement. So comps went from -7 to -5. They're guiding, you know, the midpoints here are below the consensus on EPS and comps. So EPS is basically midpoint of about $6. The street was at, call it 620. Comps are to be down, call it low single digits. The street was at flat. So you'll have to see what the commentary here is here around margins. That'll be kind of interesting to say what they think the outlook is for credit, right? The company's trying to offset some of these tail margin risks from you know, lower attachment rates of credit and extended warranties using a membership program to kind of build that into an annual fee instead of on a per transaction basis. So you know, we're not sure that's going to work over the long term, but I think the bigger point is there's risk here in 2024 around the credit side, you know, with rising bad debt costs, you know, as these rising delinquency rates get charged off. And they also have a lot of risk, right? If there's any change in late fee regulation, which is, you know, there's sort of rising probability of that something happening there here in 2024, as that's part of the profit flow of their credit portfolio. So we still think there's a lot of margin risk, and the categories remain under the pressure for Best Buy, though the rate of change is getting a little less bad here on BBY. And then Acushnet, you know, this is a Best Idea Short that's been going against us. They've been putting up, you know, good numbers, and the valuation framework going higher alongside the good number performance. This quarter was not good. So it's a lower volume quarter, but it was a headline miss on net income and revenue. So revenue slowed from +6% to -8% this quarter. Adjusted EBITDA for the year was guided ahead. Revenue was guided ahead, which we just can't get to that given what we're seeing in the space, right? Well, one of the things we just had Callaway put up like flat revenue growth and like -20% profit growth in its whole equipment business. And here Acushnet's, you know, put up positive and guiding to positive again in terms of EBIT dollars. So you know, we're looking at rising inventories because the sort of competitive intensity increasing because we had, you know, very tight supply for a few years while demand was high, and now there's plenty of product on the shelves and plenty of options and a return of promotional cadence. And the product launch cadence here for Acushnet is just not as good as it was last year. They're launching a new iron line, which, you know, something golfers tend to turn over with a lot less frequency, and they've just a lot of those golfers have just replenished their irons, which are long-lived assets. And they launched a new line of Pro Vs last year in the spring, so they're lapping against that. So, you know, everyone kind of replenishes their inventory when the new Pro V line comes out, and we're unlikely to see that this year. So we'll keep an eye on it. You know, all the data are saying it suggests that things are getting worse in terms of like visits to golf stores and general sort of demand drivers. But here the company seems to think they're going to you know, beat the expectations of growth and profits. We can't get there, at least not yet. We'll keep a close eye on that one in the coming months. And that's all I got, Keith.
All right, do me a favor. I'm in the market to buy some new irons. So if you see somebody under pressure, I'm a buyer, but I don't have to.
I'll flag any good discounts I see.
All right. Thank you. All right, here we go. Tom, having a good week, Tom Tobin.
Yeah, feel a little bit like. Actually, never mind. That's a bad reference. But yeah, no, I'll be in the studio at 1, talking about a bunch of the stuff that we've sort of had through this week. Life Stance in particular. EYE had a good quarter on the comp side, but the data tracking on same store sales, you know, continues to slow. And there's one cost item, I think, you know, in terms of an overlay that looks really interesting. So we'll talk about that. And then UHS, you know, it's almost like it gets a little boring in terms of how the thesis can change and continue to ramp higher, and there's not really much going on other that hasn't already happened. And so really you've got sort of an availability of labor, that even these guys are succeeding, and the behavioral health side, and you continues to grow in the inpatient piece. It's all sort of resolving, after 3 or 4 years of problems. Now you got 3 or 4 years ahead of upside, and it's always underestimated on the incremental margin. So that's what's happening now. And then Progeny was something that you and I exchanged emails about over the last couple of weeks. They had a bad utilization quarter, something I'll talk about. I'll put up the chart anyway. We have a decent tracker for providers, so how many people are in their network. That number actually ticked down pretty significantly to start the year, and I was like, that looks a little weird. Quad factor score is very strong. Your levels were positive. Obviously they had this little fundamental hiccup. We'll see what happens with the stock here. I think it probably stabilizes to improve. They're talking about buying back shares, which actually is kind of a red flag in my view, that they're going to do some share repurchase here at this stage of their life cycle. And then the last one big piece of news, Tenant, this should just be bought on the open, I think, it's been on my bench for a while, but they're doing this deal with Adventist, selling a couple of hospitals, but the bigger deal is that they've got this Conifer Health revenue cycle management business inside of Adventist. Now, it was a huge system, and it's just a big positive for probably a stub of a business for them, something that's been problematic for a long time, that they've been turning around and managing to work, managing to get to work. Now that they signed this big contract, right? That's a game changer for them in the context, particularly, the outpatient business doing well, the inpatient business doing well. Like Conifer is sort of the last shoe to drop. So this thing is going to be up, I think, significantly. I'll definitely, this next focus idea, you and I have already exchanged emails about this. So that's what's up. But 1 o'clock, I'll cover a lot of this stuff and sort of start detailing more of this. As one of my sales guys said yesterday, a suitcase of data, trying to distill it down and sort of share out what's going on. But that's it.
I mean, you saw that I hit the button in real-time alerts on Tenant, right?
Yeah, well, no, I mean, there's you and then there's me, right? Like I gotta get that across the line as well. It's just a little bit more than hitting a button, but that's my next step. Do a deck, get this worked out. I have most of it done already. Just timing.
I mean, does this put THC as Tenant, by the way, and HCA is the other long on the signal strength list? I wasn't indifferent. I mean, THC was closer to the low end of the range, so that's why I hit the button on that. But is there really a difference to you fundamentally?
Yeah. No, they're all the same, and then different in critical ways. So with UHS, you have a massive behavioral health business, so inpatient psychiatric, outpatient step down therapy, therapists in general. So they have a very small acute care business, reasonably good markets. Obviously, they have management differences. HCA is the mothership of acute care. It's the largest hospital system in the country. They also have a huge outpatient care business, but it's mostly physician. They have Care Now, which is like a urgent care type footprint and strip malls all over the place. And then Tenant, which for a long time was thought about as just ambulatory surgical centers. And the thesis had been, hey, we're going to get rid of all these terrible acute care businesses. Like, we're going to sell all the hospitals, and we're just going to be outpatient or skinny down at acute care. So it's mostly ambulatory surgical centers. They bought USPI years ago, and they've just been leveraging and expanding the ASC part of their footprint. So that's different flavors of the same thing, but they're all super highly correlated. You can basically do an overlay of same store adjusted admissions between HCA and Tenant, and the footprint matters, right? Texas, Florida, where your exposures are is kind of more critical than what the mix is.
Did you mute yourself, Keith?
Yeah, just getting in the car.
That's all I've got today at 1, though, if you want to learn more.
Cool. All right, Emily. are we?
Well, if you want China factor exposure, we know we sort of talked about this yesterday, and I have a chart out this morning relative to XBI versus NIH funding. One of the Biosecure Act, which took aim at a few Chinese company, one in particular, Weishi Abtec, it has caused a lot of consternation within the academic research community, where a lot of the the early stage biotech research gets done before it gets commercialized. And one of the issues there, one of the concerns is that the federal government will cut off supply of some of the raw materials for research, like animals. And a lot of that is sourced out of China. If you cut off that supply, whether that's by targeting one company, as the Biosecure Act does, you raise the costs of research, in addition to the obvious increase in cost of capital that we've been talking about for a couple of years now. So that is an area where we haven't seen the impact yet, but one of the things that experience tells us is that when the government starts making noise, particularly at a geopolitical level, about your supply chain, what do? You move it. And that is why Mexico now has surpassed China as a trading partner with the US. So that's a little chart out this morning if you want to take a look at that. And then lastly, I want to just expand on my comments yesterday about the antitrust lawsuit, the potential antitrust investigation, I'm sorry, into United Health Group. And because I've gotten a couple questions on it, one of the areas that I've been interested in and has raised the alarms on the Senate side is the way in which United Health Group has vertically integrated and done it in response to the Affordable Care Act's mandatory minimum loss ratios. In other words, you have to hand out this amount of benefits in order to avoid sending money back to your members via rebates, and that has contributed fairly dramatically to increase in the services inflation, and that's visible. All you have to do is look at a chart. Elizabeth Warren has asked questions about this. The FTC apparently is also asking questions, and that would be a area which I would pay attention to as we go forward, to see if there's any impact of the investigation on UNH's operations. And that's it.
Hey, insurance companies are making money hand over fist here. Buffett can't even hide it. It's what's going on. JT said yesterday, on this topic of what does this 1.7 going on $2 trillion deficit, going on $2.5 trillion deficit, and 35 trillion in debt mean? I mean, the answer is inflation. And JT said, you go up to somebody go up to your congressman or your senator in a grocery store and you confront them on that. I mean, if you start talking about insurance costs, I mean, people go nuts. I mean, that's one of the things that, well, first of all, we're long it. So, on the call, you're going to learn, for those of you that are new this week, it's like, I'm not bitching and moaning about inflation. I'm just telling you the truth about inflation. And then I buy inflation. So I own insurance, right? We own IAK, KBWP. Those are, two big macro exposures that we've had for a while. So you just own it. That's the point. People with money can own the inflation. The people that have no money have to eat it. And that's the political problem. So both parties seemingly are okay with that because they'll just lie about it. But anyway, it's been a big topic, medical insurance inflation. Right. Steiner, you know that one, right? I mean, that one's whipped around, in the model quite a bit. I mean, it's not a trivial matter either. I mean, people definitely freak out on Twitter about that one.
Yeah, the insurance costs, both property casualty on the homeowners and auto side, have been just blasting off. I mean, there's no other way to describe it. The rates are just and particularly in certain geographies, certain areas, it's sort of on a path toward a real crisis, because in a lot of areas, some whole states, it's getting, very difficult. If you look at like Louisiana, it's extremely difficult there to get homeowners insurance. And I think a lot of states are going to end up having to go down the road that Florida went down a while ago, which is basically creating a state-run fund, because I don't see how they're going to keep, and a lot of this isn't just, the big insurers, right? They suffer because they can't acquire reinsurance, because the reinsurance market is extremely tight. And so, the whole thing is sort of structurally impaired. But yeah, it basically leads to one conclusion, which is that insurance costs obviously are extremely inflationary, and that's unlikely to change much in the outlook. And I would add one other, from my vantage point, good way to participate in, I guess, an inflation hedged approach would be the big payment networks, MasterCard and Visa. Those companies are inherently buffering against inflation. So keep that in mind. And then, yeah, outside of that, I'm going to cede my airtime this morning. We just have our call at 12:30 today on the consumer credit outlook. It should be a really good deck, good presentation. So check that out. But otherwise, today I'm good.
Can you come back to me on PCE after? Is it come out at 8:30 or no?
Yeah, it's 8:30. Yeah, yeah, I mean, we can certainly hit on the inflation side. We'll maybe be able to get we're also interested, right, in what the January actual personal consumption expenditures on a real year-over-year basis were, right? So December was 3.2. Obviously, given the comp dynamic and the weather dynamic for January, I would certainly be taking the under, i.e. quad 4 for Jan. But we'll see what we get here in 10 minutes.
I mean, the economic data, we nailed the economic data being quad 4 in January. I mean, it's brutal. That durable goods report was downright recessionary. I mean, so the CapEx, all that stuff. I mean, what the market's trying to tell you, everyone, and that's the whole point about the signal, is that that's the bottom, right? I mean, Germany this morning, horrible economic data, and the stock market went vertical on it. I mean, it's because the market's trying to price in that the ECB is going to do rate cuts during a reacceleration in the economy, which is like really bullish if and when that happens, and really inflationary. But German retail sales, I think, were down year over year, like almost 1.4% or something. Unemployment up towards 6%. That's what the bottom of a recession looks like. So, if you're new this week to us and it's free and we get it, people can run around and say, oh, these guys, all these everyone had a recession wrong. That's bullshit. I mean, there's been an industrial recession in the country you're in. If you're listening from the U.S., a significant percentage of people watching the call, by the way, aren't in the U.S. There's been a recession in China, Germany, Europe, et cetera. I mean, Canada, good day to my homeland, obviously. So the recession, happened. It just didn't broaden into the U.S. headline GDP numbers because we decided to borrow, against our kids' future on government spending to avoid it. But I digress. All right, we'll come back to you. Simone, you on today?
Hey Keith, yeah, I got to make it quick because I got to run to meetings in Chicago. But NSA, which we have on the long active long list, reported last night. It's kind of a mixed bag. It's a little confusing in the sense that they're doing some things that should be perceived as positive, but then like at the same time they're guiding to their same store NOI being down pretty aggressively in 24, call it like the mid-single digit range versus the rest of the space that's maybe down 0 to 1. But then at the same time they're recycling capital and buying back. Well, they're paying down some debt. They paid down the revolver, and high leverage has always been kind of like not a concern, but a consideration here. And at the same time, they're buying back stock. I actually don't think they should be doing that. It kind of like doesn't. Well, let me rephrase that. If you're going to buy back 5% of your market cap per year, I guess what I would posit is like a better use of that capital would be to reduce your leverage below 7 to 7.5 times EBITDA, which sounds high to like everyone. It's high in the REIT world too, but you know, we're talking about like somewhere like an appropriate range, probably somewhere in like the 4 to 5 range. And so I guess what I would question here is like a capital allocation strategy that doesn't necessarily make sense. And if you're gonna like it, just put the company up for sale. Like why buy back 5% of your market cap if you're like indeed 30 to 35% below your NAV and you believe that number, preserve that capital, take down leverage and sell yourself. It's like a weird kind of mix of things. And at the same time, their same stores declining a little bit more aggressively than like I would have thought. Yet like, you know, it seems like the stock's reacting positively to the news. So it's noisy, I guess is what I'm trying to say. I'm trying to pick through it. And then last point before I gotta hop. On the UNH investigation, that's actually pretty meaningful in my space relative to medical properties trusts. So one of the ways these guys are trying to convince the world that they're going to earn a recovery on their disastrous, epically horrible, failed, investments in Prospect and Steward that should, be viewed as one of the worst allocations of the capital of all time. They're trying to have these companies sell their managed care businesses, which are really physician practices. And one of the things that's included in that investigation is basically like an overview or looking into of Optum, which is the physician or like physician practices business within UNH, from like antitrust and a bunch of other concerns, to my understanding. And if that's true, you're taking like one of the biggest buyers out of the market who would bid for that stuff. And that's really bad if that's the case for Prospect and Steward specifically. So just kind of like an overlap where one hand kind of speaks to the other. Just wanted to point that out for folks, and that's all for me.
Yeah, great spot to reload on the short side on MPW now that we've had the squeeze baskets, high short interest baskets that they've been up, for a week, and they typically, stop going up abruptly. So let's stay focused on that one. Anywhere north of $4 a share, lay it out there. All right. Thank you. Jay Van Skyver, who does industrials for us, is still in London. I don't, Talbot, did you guys have anything, or are you good?
Yeah, hey Keith. Just want to flag that we have our ag call tomorrow at 2 p.m. and then we also have plug earnings after the close today. And that's it.
Yeah, Plug Power. There's another. I mean, all these. I call them the top shelf, top quality shorts, meaning that they've just been phenomenal shorts, like stocks that have gone down 60 to 90% that we've been right on. Would include names like Plug Power and MPW. They're all, they all bounce, right? So when you get a short like that, like when you get like a career type grand slam short, they always bounce. The question is, do you have a process to cover some when they're at the low end of the range and reload when they get squeezed to the top end of the range? And the answer is yes, we do. Okay. So, it's critical. I mean, you gotta do that. I mean, a lot of hedge funds don't. They short low, they press their shorts. They're like, oh, here it is. And then they get squeezed. And then voila, they give you another short selling opportunity. So that's how we play the game. Always have learned it as a practitioner many, many moons ago by screwing that exercise up more ways than anybody else could possibly do it publicly, as you can see in all those timestamps that I have across all the years. All right. Apologies, I'm coming out of this cold or flu thing or whatever it is. My voice is like, what do we got? We got Friedman or Zegras?
Yep, I'm on, Keith. So a couple things this morning. We had AMC out last night, the movie theater chain, with earnings. Adjusted EBITDA was 42.5 million, but free cash flow is what matters here, was negative 149.9 million. So that brought the entire, just a dog. So that brought the full year burn to 441 million. In terms of their liquidity position, they finished the year with 911 million in cash on the balance sheet, but that's only because they raised 832 million in capital throughout the year through their ATM equity issuance. And dilution from all that equity raise was a big reason why the stock was down 84% last year. So looking ahead, we had the negative impacts from the writer's strike and a continued weak content slate impacting box office domestically year to date, which is tracking down 35% versus the pre-pandemic or 2019 levels. Adam Aron, AMC's CEO, said that looking ahead to 2024, they will not hesitate to reduce debt, extend debt maturities, and bring in more bring in more cash to the reserve as opportunities arise, which is code for raise more equity capital and dilute shareholders further. So diluted share count at the end of 2023 was 218.6 million, which was 10.5 times higher than it was in the fourth quarter of 19. Meanwhile, EBITDA is down 45% in 2023, and 2024 is likely to be worse than last year. They still have $4.6 billion in debt, which is more than what I think the equity is worth. And they still somehow have 1.3 billion in market cap left on this stock. So we're still sticking with the short on this one. This ends in two ways: perpetual dilution of equity holders or bankruptcy. So either way, should be a win on the continue to work on the short side. I'll leave that one at that. I do have something on software, Keith, to hit on, but if you have any questions, I can answer them.
No, just another great example. Like I said, Plug Power, MPW, AMC. I mean, you could go on and on and on. We're playing at such a higher level, our analysts are, than the monkeys you're watching on TV, right? I mean, if anything, they're long AMC and GameStop still, or that's what a retail investor would have done. Freebird, as you well know, I mean, retail investors are, they chase, right? Like, so, and they bag hold. So they might have bought it, like, and then all of a sudden they just sit there and they wait for it to come back. And AMC just never came back. So
and it's well, I guess never say never, but I would say the probabilities certainly don't favor it ever coming back. So and then on software, the main event last night was Snowflake, ticker SNOW.
Talk about like CNBC bag holders, right? Like Drawdown Josh Brown, like all these guys, like Cass and I were back and forth on it on Twitter today. It's like, really? Like, this is a great example, right? Because they had this really brilliant CEO who's in the business, clearly founder of selling you stock, you bobos. And everyone's fascinated with it. They don't know shit. Drawdown Josh Brown doesn't know shit about modeling companies, obviously, never mind like what software is what. I mean, but it's a ticker and it's snow and it's like this thing, if you look at the high retail, it's called the high retail sediment baskets, most widely owned names by the retail investor. This one's in it. This is a high profile stock still in terms of people really getting pounded.
Yeah, well, so just to be clear, we don't have a call on this one directionally at the moment. We are doing work on it along with many others. But just to kind of comment on the quarter itself and just what happened. So the quarter was actually fine. Revenue and operating income both actually came in ahead of consensus. The big problem here was really on the guide. So they guided product revenue growth of 22%, which was below the consensus expectation for just over 30%. And the buy side was actually a touch above that. So huge miss. Wow. And what makes it even worse is that they guided Q1 product revenue growth to 26 to 27%. So they guided Q1 to 26 to 27%, but they guided the full year to 22%. So what does that mean? Oh. That means
what?
Yeah, that means that the back half of the year, where you have more difficult comps, that revenue growth implied in that drops below 20%, which for a stock that's trading at 21 times EV to sales and 178 times EBITDA is kind of a problem. And then you mentioned, Keith, Frank Slootman, who's like a very well-known software CEO. He was the CEO of ServiceNow, which we are short, before going to then he went to Snowflake, also left. So he just totally just pulled the ripcord on investors. And this is a cloud consumption story that was supposed to be a key beneficiary of AI. Now, to be fair, their guidance doesn't contemplate any revenue from new AI product launches later this year. So that could be a source of upside, right? To the extent they've reset numbers lower, they launch these products and they monetize them. But it's still really not a good look as it relates to kind of the core business here. And a key point of ours, what we talked about with ServiceNow, is we think that we're probably entering, potentially entering the trough of disillusionment with a lot of these AI products, because while there's a lot of great stories and theoretical use cases, there's still a lot of factors to be determined where these AI products are still in a proof of concept phase for a lot of companies before. And it's not that everyone's going out, even though ServiceNow CEO would like to tell you otherwise, but it's not like every company out there is going and throwing tens and millions of dollars of incremental capital to every single software vendor for these AI products. And so the theme that we've seen, and I'll finish on this point, even with ServiceNow, is that we do have more difficult comps in the back half of this year in software land. And at least as far as the guidance goes, everyone's guiding to decent growth rates in Q1, but their full year guides are below that and is implying a slowdown in the back half. So again, we saw this with Snowflake. We saw it with ServiceNow. That's why with ServiceNow, we're more cautious on it going into the tough comps in Q3 specifically. And I'll just leave it at that.
These are absolute, like, forget about Grand Slam. These are complete cannonballs. I mean, a full disclosure, like I shorted Palo Alto yesterday on the bounce. I mean, I was waiting for it to get back towards the top end of the range there. So like I have some exposure on that because against my SPMO book or my ETF alongside of my book, I have stuff like that, right? Like I'm long momentum. So what's happening is that you're getting a huge divergence inside of momentum. And this is exactly what happens to these monkeys on CNBC, right? They don't, like, people say I'm too critical of them. Like, are you kidding me? The amount of people that own Snowflake, because like Charlie Brown's teacher, like Stephanie Lane, just ranting, garrulously ranting about why she's long Snowflake. She has no model on Snowflake. She's not a software analyst. It's like it trades at 180 times EBITDA, Stephanie. Are you kidding me? I mean, it's like, this is like people. The reason why I've been so critical to, first of all, I was at CNBC and I saw the internals of this creepy crawler that it is. There's no moral compass. They don't care about the people. They don't have like an actual accountability, mechanism to the individual at home, the home gamer who's long Snowflake today, or Palo Alto. I mean, the thing was down 30% in a day, right? And these things are getting hammered. And I think that what's going to happen here, I've been talking to institutional clients about what you just said. More to the point, let's just get to the next play, right? Like, I mean, why I'm critical, it's not like random. People die. People lose money. People really get hurt by these people who have no business recommending these stocks. No business, right? Relative to the actual job that Andrew Friedman does before he even opens his mouth on a stock, right? That's the standard at a bare minimum, okay? And we bring it to you today. But the thing that institutional accounts and I talk about is that they look a comparison, like Germany, China, to use big factor exposures coming out of a recession, industrials, manufacturing that's been in a recession for a year and a half, 2 years. They have easy comps in the back half of the year, whereas anything AI has the tough comps, right? Like NASDAQ earnings growth rate now, Friedman, if you just boil it down that way, is in this current quarter is up over 30%. Russell 2000 earnings growth is down 30%. So that's another way to say the same thing. The cyclical small cap, mid cap economy is not AI. And AI has got a lot of storytelling in it. And just final point, like if you think, like I think I'm a pretty good salesman if I ask myself, I think Friedman's pretty good at it. Like I can sell our process pretty good. But in Wall Street, you can get paid pretty well to be a good salesman. It used to be the best job on Wall Street, where you get paid the most if you had the best accounts. Now it's not, but the best salespeople in the world run software companies. These guys take storytelling and a lack of accountability in the future to levels never seen in human history, right? These guys are really cool cats until they decide, oh, ripcord, I'm out of there. Sluman, like, really? I think that's like one of the worst things I've heard. People put this guy up on a pedestal like Jesus Christ, and I'm a Catholic. I got a lot of respect for that. But man, if Jesus did that to me, left after heading into that guidance, maybe I'd become something else. I mean, I don't know.
Yeah, I can't add anything to that, Keith. Just leave it at that one. Leave it on that one.
Well, thank you. It's just like I had to say it all. It's all one thing. And it's us against them, and it's you and us against them, and it's our community against them. It's great. It's been the history of the world for many centuries.
Yep.
You don't have to be part of the same tribe. All right. All right. Thank you. Enough about that. I guess you had the commentary for Nick, and we got anything from Felix?
I don't know if Felix is on, and yeah, I stole Nick's thunder. Sorry, Nick.
Okay. All right. That's fine. Now we're running out of clock, and Glencher sucked up his clock 2 days ago. Glencher, what do you got? I'm not trying to stop you from talking, by the way.
Yeah, I know. It's the 2-minute warning, right? So, basically, interestingly, we have this pending decision that we're waiting for in the federal court on Google's the challenge of the Justice Department against Google having a search monopoly, and that its default arrangement with Apple to make Google the default search on all the Apple devices, whether or not that arrangement is anti-competitive. We got a little bit of a hint. The same judge who's hearing that case is involved in a separate antitrust case, and it's he made a ruling there that hints at his view that competitive search options to Google won't include specialized searches like Amazon or eBay for product searches or Expedia for travel related searches, which is part of Google's defense in its big antitrust case involving the Apple default contract. It's not a final definitive on the merits ruling, but there's some analysis in a decision he made the other day that hints that he's just not going to buy the competition from specialized search options. And that's been our view, that he's likely going to hold that, but this is sort of an incremental fact that suggests that will be the direction of the ruling. We'll get in final arguments in May, and a decision I would think around late summer. And again, I think more likely than not, DOJ will prevail and put that default contract with Apple, which is estimates are about $18 billion. That's 100% margin revenue. Put that in jeopardy. They'll go to a remedy phase after that. We'll see how Apple responds if it gets to that point. But this is sort of an incremental point that suggests that it won't trend well for the Google Apple arrangement. So that's it for me.
Yeah, what a signal that was this week. Google, we're down to Mag 4 now because we got minus Apple, minus Tesla, obviously from the beginning. That wasn't new this week, but Google is breaking down hard again yesterday, post our signal. All right. Thank you, JT.
Yeah, we'll be quick. You got to get back to Mr. Steiner here. So remember, we're talking about 12 approach bills. What happened over the course of the past 24 hours is that Speaker Johnson is now, along with the Democrats and the Senate, now agreed to 6 of those 12. We were talking 4 and then 8.
Ooh.
Yeah. So now we have an agreement on 6 of those 12. We're going to get an extension today, a CR today, until next week, until next Friday, where it's very likely that 6 of these 12 will pass. He has pretty much taken the side of the bulk of his Republican conference and not the Freedom Caucus on this one. So there could be some fireworks in the meantime, but we're on schedule at this point to pass 6 of the 12 next week. There will be an extension, another CR until March 22nd to come to an agreement on the other 6. Things could get a little dicey then, but right now the ship has been righted, at least temporarily, and that's it, Keith.
Righted, yeah. It's just the kicking of the can righted is what you mean by that.
Exactly right. Or wrong.
That righting of the longer term problem, which is tied, to whatever this inflation, report is. We obviously have our thoughts on the longer term inflation higher for longer, but I haven't seen it. I've been driving, obviously, but Steiner, what do you got?
Yeah, a couple of quick takeaways. First off, the inflation side was basically spot on with expectations. So no real sort of fireworks there. The month over month PCE accelerated to 0.3. That was right where it was expected. The core PCE accelerated to 0.4, also right where it was expected. The December numbers month over month were both downwardly revised from 0.2 to 0.1. That's on headline PCE, and also from 0.2 to 0.1 on core PCE. Those are all month over month numbers. On the year over year, PCE slowed from 2.6 to 2.4, and core PCE slowed from 2.9 to 2.8. So, definitely a benign inflation framework here. Yields have moved lower by a few basis points in line with expectations. On the spending side,
but before you go that onto the spending, just to be clear, this is classic Wall Street, right? Like Wall Street, certainly its media has no fucking clue, but the expectation had been ratcheted up, right? Like post the most recent inflation reports and all the internals, the street had taken up their PCE estimates. So it went, in line with revised estimates to the upside. So that's just to make sure, that you understand the concept of all. That's the shell game that Wall Street always plays. And it's the same thing for companies, obviously. Oh, they beat expectations after they walked it down on the bat line with all the analysts.
And then on the spending side, overall PCE, personal consumption expenditures, on a real basis year over year slowed significantly in January from 3.24% growth in December to 2.07% growth in January. So that, coupled with the decel in inflation, produced a January monthly quad of quad 4, as we expected. Just looking at the breakdown between goods and services, goods slowed very significantly. So goods PCE in December was up 4.7% year over year. In January, it was up 1.5. So, very large decel in goods spending. Services spending decelerated as well, but only by a little. It slowed from 2.5% in December to 2.3% in January. So that's it. The only other call out is that on the personal income side, the month over month number, which is expected to grow by 0.4%, grew by a full 1%. So that's the only other number that's a pretty significant outlier.
Yeah, the net of all that and the durable goods report, when you and Drago update our GDP Now model, has to be to the downside.
Yeah, well, we'll run it. We'll run the update, obviously, and yeah, we'll see where it all shakes out. We'll also get claims. We've got a few other things in there as well, so we'll see where it all settles.
Yeah, I mean, it makes sense that our GDP number probably got to its highest point post the non-farm payrolls number being a big surprise to the upside, and then it's just been dripping a little bit off that intra-quarter high. But it makes sense. I mean, these are things that, again, we're not about Josh Steiner's not Nostradamus, I'm not Nostrumucker. We're not making calls on everything. We're just doing our job, right? We're bean counting the economic data. We thought it would slow in January and February against tough comps. It did. But we also got long a lot of things equities, 16 different asset allocation in U.S. equities alone. So we did our job, and sometimes we get it right, and most of the time we get it right. Sometimes we get it wrong. But you can trust that we're going to do our job. All right. Thanks for doing the call.